Buonasera a tutti. Good evening. My name is Giuseppe Brusa, and of the three panelists, I think I have the easiest part, the most boring, probably. I just want to talk about three very basic concepts. Okay, the basic concept we have to analyze to understand a more difficult concept of international compliance are the basic concept of United States taxation. Definition of a U.S. person, a taxation of worldwide income. Definition of a U.S. person. U.S. person is not only an individual. U.S. person is a much larger definition of different individuals and entities. Of course, U.S. person are all the U.S. citizen. You are born here, you are U.S. citizen. U.S. citizen also, you can become U.S. citizen. At that point, also dual citizenship is considered for United States a U.S. person. Green card holders also are part of the definition of a U.S. person. And then there are the last huge categories, I think, which is the other residents. Other residents who are here by substantial present test, no matter of the documents, let's say. And the United States is going to tax all these people on their worldwide income. Worldwide income is a concept. I don't think there are too many other countries applying this concept. We were trying to find out exactly yesterday, and I found out that Eritrea is one. And I think, North Korea. I think Cuba, in a way. Maybe Philippines, I don't remember exactly. But anyway, United States is considered worldwide income, one of the basic concepts to apply in the Internal Revenue Code. And worldwide income is considered everything is income, like you would make it here in United States. Whatever you make outside United States, if you are a U.S. person, is considered worldwide income to be reported in United States. Salary earned by abroad, interest earned by bank accounts abroad, dividends from investment abroad, real estate abroad. Income from real estate abroad is considered worldwide income and taxable in the United States. Selling house abroad is considered a capital gain in the United States. What does it mean exactly? It means that you have to report it. It does not mean necessarily that you have to pay taxes or more taxes, because whatever you have already paid in the country where the transaction occurred, you are able to consider a tax credit. Tax credit not necessarily is dollar against dollar. It's very difficult percentage to calculate in most of the cases. Is something that we do normally, but at least you have a credit to deduct from your tax bill in the United States. Is this credit valid also for state where you live in the United States? No. States are not generally covered by tax treaty with different nations. So you have to pay the taxes in the state where you reside, California, New York, wherever you reside, in the United States, besides the federal taxes where you have a foreign tax credit. Then it comes the part that we are here to discuss, and my colleague will go deeper in the discussion. Mike introduced this different concept of compliances. I would like to add one thing. There is a mixed concept in general idea. Everybody thinks that it's only in the last 2 or 3 years that we have this problem on compliances, including CPA. Unfortunately, or fortunately, the United States has always been enforcing most of these compliances, except Form 8938, which was introduced last year, fiscal year 2011. The other compliance are very old. BAR, it goes back to when you have to report the foreign financial account and bank account. It goes back, it was before my time, 1970. And I don't know if we can say, the enforcement of these compliance by the IRS, as Mike said, became in the last 2 or 3 years a must. We don't have anymore any discussion in our office without considering these issues, which is a little bit different of what we were used many years ago. One extra subject, very important and very difficult, we will have later on eventually the discussion in technicality to Sarre, is Form 8621. Form 8621, in very simple way to give you an idea what is related to, is reporting passive foreign investment company. Just to make it easier, because it's very difficult concept and very deep concept, 861, passive foreign income investment, is mainly related to mutual funds. Just to make it easier for you. Mutual funds, foreign mutual funds, meaning not US mutual funds. So if you have investment, let's say in Italy, in different SICAF, fondi di investimento, you have to be very careful on what you report on this form and how you report it. Besides the fact that, to complicate the issue, since this year, correct me, Sarah, is correct, fiscal year 2011, the 8621 is no longer only to report transaction, make money or not. It's really just a compliance transaction with all the information to be reported. So it makes it more difficult for everybody. When I say more difficult, it's more difficult in terms of compliance. Most of these situations, which may scare you, are just compliance and reporting, meaning that generally your tax bill does not have a big change generally. But you have to comply with all the regulation, the new regulation, that all these issues are brought to the table of the professionals.